안녕하세요. 저는 enwright 디셀스라고 해요. Unfortunately, I know no more Korean, only so little. So thank you very much for coming today. I'm the Managing Director for India Tax Services based in Hong Kong. And my role is to help Asian companies, Korean companies, Japanese companies, Chinese companies, companies in the region who have existing operation in India or are planning to invest in India. So I work very closely with my colleague Kim Yong-pil and the other Korean colleagues, Korean office, to help Korean companies in India. So today is going to give you just a little bit of overview on the India situation. So to start off with, as you know, India has, the last year has been quite difficult, challenging year for India, particularly for the finance minister, because in India we have a general election coming up. Also because of the global slowdown in the Indian economy, it was quite difficult for the finance minister to present his budget. With that in mind, the finance minister has taken some good steps in the budget. It's quite a difficult time for him. In India, the way the financial year works, as you know, is from April to March of every year. So these budget proposals are for April 1, 2013 to March 31, 2014. So in India, we have two types of taxes: the direct taxes, which is income tax, and also the indirect tax. So for the indirect tax, which is your custom duty, sales tax, etc., most of the changes proposed by the finance minister in the budget takes place immediately. So the next day they start, except in certain situations like the voluntary compliance scheme for service tax, which the date is to be announced. And for the direct tax, again, most of the provisions take place or take effect from the 1st of April 2013, except where there is a specific date. So for example, like the buyback provision, which is on the 1st of June. So that is the background to the Indian budget. So if you look at some of these figures, which just show you the growth of the Indian economy in the last 10 years or so, Indian economy grew at 8% over the last 10 years, only second to China. But of course, in the last year, you can see the growth has fallen to about 5% for the year ending 31st March 2013. And for next year, we expect somewhere in the region of between 6 to 7% growth in that region. So why has the growth fallen so much? So the growth has fallen really in the last year because of a number of factors. The overall slowdown, what we call in India policy paralysis, where the government has been slow to take actions to make investment faster. Also the poor performance of the agriculture and industrial sector. The service sector has performed well, but the agriculture and other sector has not performed well. So that is the reason why the growth has fallen, and it has come off from being a very high growth, and also because it weathered the global recession quite well. But in the last year, it has struggled to keep pace with the growth. So the big two problems facing India today at the moment from a financial point of view is what we call the current account deficit and the fiscal account deficit. So these are the twin deficits which are the most worrying factor for India today in terms of which is holding back its growth. So the current account deficit is really a trade deficit. It's the difference between export and import. So what has happened in the last year is the export has slowed quite a lot, but the import has increased substantially. As many of you know, India imports over 70% of its oil requirements from overseas. So that is a significant contributor to the exports being high. The other big area was also the import of gold. So India is the largest importer of gold. So these two factors have contributed quite a large amount to the current deficit problem. And the current deficit in the last quarter of last financial year hit the all-time high. Similarly, with the fiscal deficit, the government has revised its estimates, and it wants to limit the fiscal deficit to 5.3% of the GDP. And the fiscal deficit, the way the government will tackle that is through a combination of reducing subsidy. You may know that in India, the petrol prices and fuel prices have been subsidized by the government. So this is slowly being released. The subsidies are being taken away. The government also plans to increase tax revenue which we will see later on. The government is also proposing that what it will do is that it will also divest some of the public sector holdings that it has. The government owns equity in many public sector companies like oil and gas companies, coal companies, so it wants to sell this in the international market and therefore reduce its fiscal deficit. And the last point to worry about slightly is the credit rating situation. Because of the current deficit and because of the fiscal deficit, the international ratings agencies have placed India on a watch. So they have not downgraded it. They have not said that the outlook is negative, but they put it on a watch list. So if the rating falls by one level, then it of course impacts the investor perception, it impacts the flow of money coming in, it impacts the ability of Indian government to borrow money. So this just shows you again some of the positive and negative factors. As I said, India was growing very, very well, average 8% over the last few years. This has slowed down to 5% or so. The final figures are not come out for the March 31, 2013 year, but we expect it to be around 5%. And the main reasons are the global slowdown, the Eurozone crisis, the slowdown in exports in India. Also, there are issues like, as you know, India has very high interest rate, high inflation because of that. So those also contributed to slowing in the growth and slowing down in the investments, private investments which are made. On the positive side, over the last few months, we have seen quite some good indicators. So, for example, the Sensex went up to 20,000. Of course, it has fallen back in the last month or so after the budget. The foreign investment, the foreign institutional investment, which is all the institutional money coming in from the institutional managers, India has attracted around 7 billion in the last month of January and February. And in the last quarter of last year, about 10 billion US dollars. Also, the index of industrial production has increased, which shows that people are optimistic about the future of manufacturing. And inflation has come down to the lowest in the last 3 to 4 years, plus exports have surged. So overall, I think there are some positive signs, and this will increase also. So with all of that, it was quite a difficult task for the finance minister, because with the current account deficit, with the fiscal account deficit, also going into an election year, the finance minister has to have a very carefully balanced budget. On the one hand, he cannot give away too much. On the other hand, he has to make sure that the deficit does not get worse for the reasons I mentioned. So what he has done is a somewhat difficult balancing act. So on the one hand, they are focused on certain measures, which will of course increase the budget. But on the other hand, there are also opportunities, and the opportunities are mainly in the area of better food management, better irrigation, getting rid of the subsidies, also and allowing more foreign direct investment into the country. So I don't know if you have followed some of the stories, but in the last 6 months they opened the aviation sector, the retail sector. So companies like IKEA are very close to signing an agreement with the Indian government to invest in a big way in retail, both in the front end and the back end. Also then, as I mentioned, in food management and other subsidy areas, the government is taking some steps to improve the position. So with that, the government of India, basically to manage its fiscal position, took 2 steps. So one is it increased some taxes slightly to improve the fiscal position, but also the finance minister also made some interesting comments. So one, he said that in the long term, India must have growth which is sustainable. So we cannot have 8% and then 5% and then 8% again. So the goal is the magic figure of 8% over the next decade. But to do that, the finance minister announced certain key measures. So he said India cannot grow without foreign direct investment, called FDI, cannot grow without foreign institutional investment in the stock markets and debt, which is FII, and cannot grow unless we have also the ECB money coming in. It's also the finance minister and the prime minister recognize that India needs to become more friendly towards foreign investors, make the overall environment for foreign investment much better. So again, this is another area which the government is going to focus on. In terms of the key tax policy, as you may know, there is something which India proposed in 2009 called the Direct Tax Code, and various parts of the Direct Tax Code have been already included in the tax law, but they propose to include some further parts in the coming session of Parliament. It is also proposed to introduce the goods and services tax amendments to the Constitution. This will also, the goods and services tax, if it goes through, will make a big change to the way business is done in India. It will improve the flow of goods and services in India. The other two areas which the government has also promised is, you may have heard of SEBI, which is the Securities and Exchange Board of India. It's like the Financial Services Commission. So it's the regulator for investments in stock exchange, investment in listed debt. So again, on the capital market side, the government is proposing that they will open up the markets to more foreign investment. So currently there are different categories of investor. There is the FDI, the FII, the QFI. So it's very confusing and for foreign investor coming in. So what they want to propose is that foreign investor which is less than 10% holding an Indian company will be created as FII. They will simplify the procedures for foreign companies to invest in India. So hopefully we expect to see some of this in the coming months, together with perhaps a pensions bill and also insurance bill, which will allow more investment by the pension and insurance companies. So overall, in terms of the budget, how do we rate it? We would say the budget is a mixed bag. Because it has different things, it has pluses and minuses. So on the plus side, you could say, the budget hasn't done too much damage. It has not tinkered around with too many things. On the negative side, we would have, some of the things that you may have heard of, the famous Vodafone case, which involved indirect transfer of shares outside India, which went to the Indian Supreme Court, and India changed the law retrospectively. So we were expecting some clarification and certainty in the budget on Vodafone, but that did not happen. Also some clarification on the GAR, but the GAR has been deferred to 2015, which is good, but there are some aspects which could have been made better. On the other side, in relation to there are some negative aspects, like they increased the withholding tax rate on royalty. They removed the possibility of buyback, both of which affect Korean companies here. On the other side, they have increased the tax rates for super high income earner. So if you're an individual, or if you're a company and you're a company earning more than 100 million Indian rupees or $2 million US roughly, then the tax rate has gone up a little bit. But that we expected some increase in tax rate because of the deficit situation. So now I'm going to focus just a little bit on some of the key changes. My colleague, who is the next speaker, Kim Yong-pil, will talk about them in more detail, but just a high-level overview. So as I mentioned, the tax rates have gone up. So the surcharge, in India you have the tax, and on top of that you have something called a surcharge. That's why the tax rate is always something and 0.22 or 0.33%. So the surcharge has gone up by 10% for companies earning in excess of 100 million rupees, or roughly around 1.8 to 2 million US dollar. And for them, the new tax rate, effective tax rate, is 33.99% or 34%. Also, the dividend distribution tax has gone up from 16.22 to roughly 17%, and similarly, surcharge has gone up on the MAT. The other one to keep in mind is, as I mentioned to you, in the last 2 years, the sectors which have fallen behind are manufacturing and agriculture. So to encourage more investment in manufacturing sector, the Indian tax law is going to be changed to give an additional deduction for companies who incur expenditure on brand new plant and machinery. But the difficulty that we see there is that the threshold is 1 billion Indian rupees or 20 million US dollar, which is quite a high amount. When you consider that most of the manufacturing will be done by small and medium-sized companies, not very large companies, we feel that this incentive, the threshold, should be lowered from 1 billion rupees or roughly $20 million to much lower. And also, as many of you know from your own experience in India, many of the projects never happen on time. There's always delay with regulation, there's delay with approval, or delay in execution. So this deduction is only available for 2 years, and we feel the government should make it maybe 3 years or 4 years so that the companies can do the projects on time. On the international tax side, there are a number of changes. So the first one is tax residency certificate. So last year it was made mandatory to have a tax residency certificate. So in very simple terms, if you're a Korean company claiming benefits of India-Korea Treaty, you must give the Indian tax authority tax residency certificate. Otherwise, they will not give you the benefit of the tax treaty. But they made an additional condition to say that if just giving the tax residency certificate is not enough, and you must, the tax authorities have the right to challenge and go behind the tax residency certificate. Of course, this caused panic on the day it was announced because, as many of you may know, about 40% of India's foreign direct investment comes from a little island called Mauritius in the Indian Ocean. And that is mainly for, quite a lot of that is for tax planning. So many of the financial investors invest through Mauritius. So the day this was announced, the stock market fell 280 points the same day. And the government issued a statement the same evening saying that as of today, the tax residency certificate will be accepted by the tax authority, and they will not question it if it is given. So this is an important one to note. The second one is that the rate of withholding tax on royalty has gone up from 10%, 10.5% under the Indian domestic law to 25% under the domestic law. But of course, if you are a Korean company and you can claim benefit of the India-Korea tax treaty, there is an increase. The India-Korea tax treaty has a rate of 15%. So it will be more expensive now to take a royalty. Now this provision applies from the 1st of April, but there may be some opportunity if you have already not taken a royalty to look at extracting that royalty very quickly because this has not yet become the law. The other one is called a share buyback. So again, if you're a Korean company, you have an Indian subsidiary, one of the ways in which you can take out money back, your profit, is by way of a share buyback. And under the Indian tax law, before this change become effective, that transaction of buyback is not taxable in India. So after you pay your 33% India tax, you do not have to pay a further tax of another 16% if you do a buyback. But this is going to be changed from 1 June, and again, Kim Yong-pil will cover in a little bit more detail. The next one is the GAR, which is the anti-avoidance. So what India is trying to do is they're trying to say if you have a very artificial tax scheme which is trying to avoid tax in India, then we can override this by applying the anti-avoidance rule called GAR. Now, the good news for GAR is that it's deferred to 2015 for financial years starting on the 1st of April 2015. So it was supposed to start from the 1st of April 2013, but now it's pushed back by 2 more years. So today it is not the law. The second thing is that one of the main object of any scheme to save tax must be avoidance of tax. So that is a positive factor. On the negative side, they have not excluded foreign institutional investor. So if you have a foreign institutional investor who has invested into India using a tax treaty of Mauritius or Singapore, like many people do, they are not excluded from this. The other one is that there is a treaty override, which means that if, for example, a company uses a Singapore or Mauritius company for no reason, only for tax, the GAR can override the tax treaty. Now, India had an expert committee to deal with GAR, and the expert committee made these recommendations, but the finance ministry has, while they said we accept most of the recommendations, all of them is not present in the wording of the finance bill. So this is an area which we hope will also be changed in favor of the taxpayer. So the next one here is just dealing with commodities transaction tax. So this is a new tax which has been introduced. It was originally going to be introduced in 2008 and was not brought in then because of the financial crisis and so on, but it now applies. But this has very limited application. So it only applies where somebody sells, it applies to derivative contracts where a seller sells a contract for trading in commodities. Now it does not apply to agricultural commodities, and the date when it comes into effect is not specified. And it is the seller who pays the tax. As you know, in India, there are, that is all on the income tax side. The indirect tax side is pretty complicated also. And there are various different taxes. So we have custom duty on import, you have excise duty on manufacture, you have sales tax on sales, you have service tax on services. And there are some other taxes as well, but these are the main ones. So insofar as the indirect taxes are concerned, the peak rate which you see there of 10, 12, and so on, they do not include the surcharge, those rates, but none of those rates have been changed. So the rates have all remained the same. But also remember in India that if you operate in certain states, say you operate in Gujarat or Tamil Nadu or Maharashtra, they have their own budget and the local sales tax rate may change. So just keep that in mind. This is only the central government for all over the country, okay? There are some specific changes in custom duty, excise duty for specific products. So for example, if you import SUV cars from Korea, then the rate of tax has gone up. If you, on the other hand, import lithium batteries for mobile phone, the rate has gone down. So there are very specific points on the rates. Also for excise duty, if you manufacture garments out of India, the rate has been reduced and there is some exemption. So it depends on the specific rates of the specific good or service you're providing. There are also some exemptions provided there. So that's something. The other two important points to note is many of you may have Indian subsidiary, and some of you over here may be a director or officer in that company. So there are some provisions which have been introduced where the director, if the company does not comply with the tax law for indirect taxes, and there are some fines and penalty which can be levied on the directors. And also the directors can be arrested or by the tax authorities if you do some, of course this is some very serious offense like tax evasion or issue false invoice or those kind of things. So just something to watch out for. The last one in this slide is on service tax. There is a voluntary exemption scheme. So in India there are 1.7 million people who register for service tax, but less than 700,000 people file tax returns. So the government has introduced a scheme. So if you have a tax liability from previous year, but you have not filed the return and disclosed, you can make a voluntary disclosure and they will waive the penalty and the prosecution. So, but the date for this scheme has not been announced yet. So that we expect in some time. So the last slide is on GST. As I mentioned to you, there are many different taxes on the indirect tax side in India. So for a long time, there has been a proposal to basically have a single goods and services tax, which will almost replace all of the excise duty, the sales tax, the service tax, and some parts of the custom duty. So, and if that happens, it is expected that just doing away with this tax will result in about almost 2% extra growth to the Indian economy. Because today it is, if you have operations in India, it is very complicated to sell goods from one state to another, and there are very complicated strategies to deal with that type of situation. So this is expected to open up the market and free up the market. The biggest challenge in this, getting this off the ground, is political. And the reason is that under the Indian Constitution, the states have the right to levy sales tax, and the center has the right to levy central taxes. So they have to come to an agreement in terms of how the states get compensated for this, what will the rates be, etc. So that is in the process of happening, and but the only thing I would say is it may not happen this year. It might more likely happen in 2015, simply because politically India is going to an election. The coalition has to stay in power. So this may not be the top priority for them. It may be just to hold the government together. So that is the end of my presentation. Gumap Sumnida. I'm here to take any questions afterwards. If you want to meet me, I'm available later on. Thank you.